everyone, and welcome to yet another episode of Money Matters. As you know by now, Money Matters is an interactive show that aims to educate our viewers on money-related matters. Do you perhaps have a money-related question or you need advice on any money-related matter? Please do engage with us, and we may see what it is that we can do for you. But for today, joining me in studio is Jimmy Muyaha, and we will be talking repo rates and the impact or the ripple effect that has on the things that you and I experience on a daily, such as the price of food. Welcome, Jimmy, and how are you?
Thank you for having me, Joy. I'm well, thanks. How are you?
I'm good, thanks. Tell us a bit about yourself.
I've been in sort of financial services for probably close on a decade now at this stage. Looking at everything from the repo rate to alternative investments. It's currently where I'm focused at the moment. I write a couple of columns in some of the media publications, and I do these sorts of things where I aim to help people understand finance and financial services and just unpack complex things.
And make it simpler for the people. Jimmy is indeed, of course, an independent financial expert. And thank you for joining us, by the way. I think, it's been a lot happening, right? And it's globally, right? We've seen how, reserve banks or the likes globally have been, working in order to try and manage the situation around inflation and the things that they do, right, to sort of create a balance in the economy. Let's perhaps just go into the basics, right? When we talk repo rate, what exactly are we talking about?
So the repo rate is, in a nutshell, the rate at which the central bank, in our case, the South African Reserve Bank, loans money to commercial banks. And from there, the commercial banks will then loan that out or loan those funds out to you and I at what is known as the prime rate. Now, the repo rate and the prime rate are different for that reason, is that the bank almost has the commercial banks almost have their premium on top of that, so that they can make something back for the money that they've loaned out.
That's the risk that they are taking, I suppose, in the whole transaction. And you've mentioned, obviously, central banks. And, in South Africa, we have the South African Reserve Bank. We're so used to them. I mean, we've heard quite a lot happening there. And coming from we've heard the MPC sitting. And I suppose MPC meaning the Monetary Policy Committee, right?
Yes.
They've got an important task that they need to do. What is their role?
So the central bank and in particular the Monetary Policy Committee within the central bank. The central bank's aim is in part currency protection, but from a monetary policy point of view, the basic aim there is to measure or to determine how much money actually needs to be in supply in an economy and in a country. And almost a secondary mandate to that is the protection of that money. That's why we get into conversations like inflation and conversations around interest rates and that sort of thing. So once the monetary policy itself has determined this is how much needs to be in circulation or in supply within an economy, then the secondary role is how do we protect that value and ensure that that amount of money is there when factors like inflation come into the fold, when factors like interest rates and those sorts of things. So those are mechanisms used by the central banks and by the Monetary Policy Committee in particular to maintain the stability of that money concept that we know of.
And I suppose the economy at large.
That's it. Because if you have to think about what that represents, it means what we transact with, right? So what governs everyday transactions, whether it's you and I, whether it's you and the bank, whether it's the banks with other banks and that sort of thing. So it's a very critical thing to be able to, one, maintain what is in circulation, but two, maintain that consistency in terms of the value of what is in circulation. So think about buying bread, right? You want to be able to come into a store, buy bread, and know that if I go to another store, I can, the 10 Rand that I have is still the 10 Rand that I have.
So maintain its value.
Yeah, so you and I don't see it as necessary for them to intervene, but they are a critical part of the ecosystem that is money as we know it and transactions as we know them.
Maybe let's remind our viewers, when you're talking the concept of inflation, right? Because you've spoken about the central bank's role largely, or the monetary policy's role, committee policy's role is the monetary policy committee's role is making sure that, they also look into the supply, and how much of the money is actually in circulation. Let's maybe just bring that into, just reminding how that has an impact on inflation and what that means, for viewers.
Sure. Very simply, if that mug costs 10 Rand and there are a finite number of 10 Rands in circulation, and the central bank suddenly comes out and prints more money, that means that there are more 10 Rands in circulation, which means more people can access those 10 Rands. What that means is then that the purchasing power of that 10 Rand is not what it used to be. So the whole principle behind economics, money, pretty much everything that we really do in trade is demand and supply, right? And if you think about too much supply means that demand needs to now come up and match that, right? So if the monetary policy, or if money in circulation is in abundance, it loses its value.
Yeah.
It is valuable because it is scarce. It is valuable because it is controlled. And so if inflation gets out of control in a country, what it means is the cost of purchasing goods, or the cost of, it's typically measured as a basket of basic goods and that sort of thing. So the cost of acquiring those goods is increasing. Therefore, we need to make different decisions. It means you and I need to either allocate our money differently. It means we need to get more money and that sort of thing, right? So that's how the inflation part of it fits into the ecosystem. Now, to that end, your monetary policy in your central bank then comes in and says, if the value or the cost of things is too expensive, then it means that the 10 Rand that we had given, or the 10 Rand that's in circulation, is not sufficient to then meet those needs or those requirements. So us as a central bank have to now issue more money, right? So that those that are out there can use the money to afford the goods. That's one of the methods they can do. It's printing the money. Something else they can do is say, hang on, if we just make sure that this cost thing, this inflation number, is below a certain range or is in an ideal range, it means then that the 10 Rand that you have still has a significant amount of value. It still has, so the cost of things that you purchase with it doesn't go up excessively.
You can still afford,
Exactly, and that's where the debate comes in. So that's where the conversation around, is inflation targeting necessary? Why does the central bank determine 3 to 6%? All of those conversations come in when you look at the impact that inflation then has on what you and I are able to afford and do with our money.
And I suppose different countries obviously have different monetary policies right in place. How different are those policies, and why do they have to be different?
Because every country is at a different life cycle within their... So remember that the aim is for an economy, right? It's at an economic level. It's the circulation of money within that economy and how that economy then functions, right? So if you think about South Africa versus the United States. South Africa has a monetary policy right now that is aimed at getting inflation back down to 3 to 6%. The US has currently got an inflation of 4%. And they want to get inflation down to 2%. So first of all, we have different inflation levels, which means we have different policy measures to address that inflation level.
And policy.
And policies themselves, exactly. So if you look at the policies as policies, you sort of have a conversation around things around expansionary policies, contractionary policies, those sorts of things. What that basically means is the MPC has an objective to ensure that the economy is operating at its optimal point, right? And to do that, they have to deal with the other factors. Now, the other factors are a fiscal policy. And a fiscal policy is what National Treasury determines, right? So when you look at the economic picture as a whole, the central bank has to make sure that the money in circulation is enough for everybody to be able to participate reasonably within the economy and those sorts of things. But they can't do that on their own. They rely on other things being in place. And when those other things and those other factors are not where they should be, a prime example in South Africa, load shedding. electricity supply and energy security is not where it should be.
Correct.
As a result, we have load shedding. What does load shedding do? It affects businesses' ability to operate, mine and yours ability to get to work, to cook, to do all those things. What does that do? It has an effect on the economy.
Correct.
Now, the MPC has to step in to ensure that those rands that we spoke about and that money that we spoke about still has the ability to weather these instabilities.
Yeah.
Unfortunately, they don't have control over those instabilities.
Correct.
So they don't have control over determining things like the fiscal policy, things like load shedding. And so that's where you start to see that there's a divergence, and there's almost this two centers of conversation where the central bank says one thing, but it's not working, or the central bank does something and it's not having a desired effect. Because we must remember that when we look at that picture, there's a lot more than just the central bank deciding on an interest rate.
Yeah, there are a lot of factors at play, I suppose, as we've put it. But I think I just want to pause there because I want to come back to that. It's quite a pain point for me, and I suppose not only for me but for our viewers at home as well. We need to take a short break, and I think for our viewers at home, as you've heard, it is quite a topic that touches not only I, but you as you are seated right there, because there's a lot of things that we need to think about, right? The ripple effects, the cost of food, the cost of credit itself, and what that means for all of us. But please do stay tuned, because we are coming back after the break. But continue having this conversation with us. Share your thoughts, opinions. What are some of your fears when it comes to, this ever-rising repo rate? Because we are quite keen on hearing your thoughts. Don't forget to use the hashtag MM on SID, using the details as they appear on your screen right now. But we'll see you just after this. Welcome back. You are still tuned into Money Matters, and we are talking repo rates, the role of the central bank, as we know it in South Africa, the South African Reserve Bank. And joining me for this very exciting and interesting conversation is Jimmy Muyaha, an independent financial expert. And Jimmy, before we went on to our ad break, we were unpacking, right, some of the various elements that speak to all the things that we're seeing, right? And things that people actually don't even understand. Inflation, what informs inflation, and the like. Can we maybe just then unpack some of the, for example, you spoke about load shedding, right? How does that have an impact on inflation?
So the mechanics of it all are that everything is linked. Whether we want it to be or not, it is, right?
Yeah.
And the impact is then also felt within the cycle. So let's take the load shedding example. The load shedding example in South Africa has affected everybody, right?
True.
Retailers have come out to say that they've incurred in excess of 700 million in diesel costs and other load shedding avoidance costs. Food manufacturers have come out with similar figures as well when they've reported their numbers. Now, what that means is if you take a retailer that spent 700 million on diesel costs in a particular period, that 700 million is a cost incurred to provide the same level of goods and services that they planned to provide anyway. So they're incurring a higher cost to deliver the same thing. They have the option to absorb that cost on their book, or the option to pass that cost on to you and I. And more often than not, when they pass it on to you and I, it means that the things that we purchase now cost more, right? And that is what we then experience as an inflationary impact.
Correct.
Now, South Africa is dealing with another factor where it relates to some of the things that we import, right? Now we bring into the whole inflation picture the effect of currency, right? So we are a net importer on most things, like fuel, for example. We import 60% of our fuel in South Africa. What that means is the rate at which we import the fuel is exposed to the rate of the rand, the exchange rate of the rand. And so if the exchange rate of the rand weakens, it means our import costs go up.
Yeah.
And that's why you and I experience fuel price increases, right? So now take that cost coupled with the cost or the general increase in the cost of living, which is the inflationary side of things. And that means that you and I, for the same things that we are used to buying or acquiring, are now paying more for that.
Exactly.
As a result, this is a direct result of load shedding, right? If load shedding is resolved and energy security is taken care of, it means producers, it means retailers, it means all those participants within the economic system or the ecosystem that is our economy can operate at a reduced cost, which means the cost of goods and services that you and I acquire is then brought down. So that's how you can see that there's a direct correlation between those sorts of things. And to that end, you look at the monetary policy, you look at the Reserve Bank of South Africa. The Reserve Bank of South Africa's mandate is, as we mentioned earlier, is to protect that currency, right? Now, if they can see that inflation is running away at 7 or 8 or 9%, they have what they know as their little toolbox, interest rates and other measures and that sort of thing. They use the toolbox to bring inflation down so that the cost of things for you and I is manageable or kept within a certain manageable range. They don't have control over those load shedding factors that we spoke about. So it is not their responsibility. And this is where we often misunderstand when the central bank increases interest rates and we say, but how can you do that? Because you're not helping us. Yes, they're not helping us. But if they sit on the sidelines and do nothing, the potential effect of them not intervening could be even worse than if they were to step in. And so that's where they have a careful balancing act to maintain. And that's where it's also the responsibility of those that set other policy to ensure that that other policy is conducive for the monetary policy to be able to do its job.
What are some of those internal factors then that we need to be cognizant of, I suppose, as South Africans, right? Because I'm parking the external factors that have an impact on the rand or the strength of our currency. But what are some of those internal factors that we just need to be aware of that have an impact on the value of the rand?
So if you look at inflation is typically broken down into two things, demand side inflation and supply side inflation, right? Demand side inflation is what you and I can control, where you and I spend. You and I go and take on more credit. We use the credit to buy luxury goods, to go buy clothes. We have clothing accounts, those sorts of things. That is demand side inflation. It is what we demand that drives up and down or that affects the price of what we consume. And so the supply side of inflation is factors that are not determined by you and I. That's where we look at things like load shedding, things like the cost of production. That's where the costs that producers have to contend with. That filters into supply side of things. Now, monetary policy is designed to have a different type of impact on both these sides of things. Think about it as sort of two sides of a scale, right? If demand side gets too much and there's too much happening on the demand side of things, the central bank intervenes, increases interest rates. What does that do for you and I? You and I have less money to spend. Therefore, we redirect and refocus where we put our money. And that reduces demand for certain things. And that's how they balance that side of the scale. On the supply side, exactly the same thing. There are factors where the consumer or the producers are incurring a large number of costs. They then need to manage that. And so the central bank then steps in and says, okay, we're going to then make sure inflation comes through to this point so that you as the producer don't incur such a significant increase from your suppliers and that sort of thing to provide those goods to the economy, right? So that's sort of the two sides of the scale that we have to look at. Unfortunately, what's happening right now in South Africa and in most of the world is it's not demand that's driving inflation. It is the supply factors, the factors like load shedding, the factors like an increase in the production costs and that sort of thing. And those factors, when the central bank intervenes or when monetary policy comes in and says, we want to address this, their tools are not often optimally designed to have as significant an impact. So if you think about interest rates, we can see if an interest rate increase happens, your bond costs more. Your car repayment costs more. You have less in your bank account
Correct.
already. Your credit card costs you more to repay. So you make different decisions. So it has a very, very strong impact on the demand side of it. But you take that same interest rate adjustment and you put it on the supply side, the producer has to still produce the goods. They still have to supply us with what we need anyway. What they then do is then they decide, okay, do we absorb that cost on our side, that increased cost, or do we pass it on and it comes through in the price? And that's where you can see that one instrument, one tool, like the interest rates that the MPC has different effects on you and I as consumers versus on the supply side of inflation.
And I suppose this conversation is quite complex, right? Because as you're speaking, in my mind, I'm thinking, obviously, then companies can either decide to retrench people, right, to contain their costs.
Yes.
And what that means from an economy perspective, and, you know, and I'm just thinking the role that government, or the important role that government ought to play in making sure, right, that the environment is conducive enough to aid, you know, employment opportunities, to aid such, you know, such things. Because now we are sitting here as an example, and we have the governor who is trying to make sure that South Africa is still very attractive from an investment point of view. And to make, I mean, if there's, like you said, demand supply, if there's more supply of the rand, you know, and the demand is, you know, it just makes the rand a lot more cheaper. And then what do you do for external investors? You increase your rates to make the rand a lot more attractive. And so there's still quite a lot of factors at play. But why is it important that, you know, that government steps in to sort of make sure that the playing field or the environment itself is conducive for the governor, for other players in the market, and for business?
I particularly like that you mentioned the government's role in all of this, because their role is more fundamental and more critical than that of the Reserve Bank governor. The Reserve Bank governor has a mandate. His mandate is twofold: currency protection and inflation targeting. They are interlinked because one leads to the other.
Yeah.
That is all the Reserve Bank is mandated to do, to ensure that that currency is there and protected. It is the responsibility of the government to ensure that the environment in which that currency is deployed is a conducive environment. So it is not the responsibility of the government to create jobs, for example, but it is the responsibility of the government to create a job-friendly environment. The private sector is more than happy to create jobs. There's enough business opportunities where if the opportunities are there, people will create the jobs. But if the conditions are not favorable to that, and those conditions, unfortunately, are the sole responsibility of the government. They're not the responsibility of you and I. They're governed by things like the fiscal policy. And that's why when you see institutions, international institutions say that the credit risk rating of South Africa is this, or the growth outlook of South Africa is this, and they say that the fiscal policy, we need things like fiscal reforms and that sort of thing. That is a direct statement from an international investor, potential investor, or an international outsider looking into the economy, saying that the government needs to create the environment that is conducive so that when the interest rate adjustments happen, they have a stronger impact. Now, what happens when that isn't in place is you find our central banks doing what they have to and what they can, but you find it not having... They're always in a difficult situation. They're always on juggling a very thin balancing act. Take the South African central bank, compared with the US central bank. In the last 10 rate hiking cycles of either bank, South Africa's moved its interest rate up by 475 basis points, so 4.75% for simplicity's sake. The US has done 5% in that same time. So you can see that we're pretty much benchmarking on the same trajectories. The US has gotten their inflation from what was at some stage 7 or 8% down to 4% with a target of 2%. The South African side of it, we're still 6.8%, above 7% or so, trying to get back to between 3 to 6%. Now, you can say that the monetary policies of these two might look very similar, might be aligned. Some have even said that we take our monetary policy from the US. But look at those other conducive factors that we now need to look at, right? The US has an unemployment rate of less than 5%.
Correct.
South Africa's unemployment is closer to 50%. That is as a result of the conducive environment that has been created by the United States government for businesses to operate in the United States and for people to survive in the United States. So when you ask the role of the government, just look at it from that perspective. And don't look at the number and say, okay, but then the government should be creating more jobs. Again, I said this, and it seems very controversial for me to say it's not the government's responsibility to create jobs. It is not. But it is solely their responsibility to give us all an environment where job creation flourishes, where job opportunities are abundant, where foreign direct investment says, I, as motor company A, am going to open a plant in Uitenhage, a plant in Roslyn, in South Africa, because I want to put money into that economy. That creates jobs.
Quite a passionate, I can see you quite passionate about this very one. But unfortunately, we've come to the end of, the time for today's show. I wish we could go on and on and on, but I think it was quite an insightful conversation. I wish we could have a part 2 because there's a lot to unpack about this very topic that we've been discussing. But thank you for your insights and your expertise, and as you have gladly, shared it with our viewers at home. But for you at home, I hope this is not the last we converse on this topic, but please do continue engaging with us on our social media platforms using the hashtag #MMOnSID. And I hope that you really learned a lot from this conversation, and that you've learned as much as I did on why it's important that we really understand how the ins and outs of the economy work, so that we can manage our finances a lot better. And but for now, I will leave it at this. And from me, Joy Maliti, and the rest of the Money Matters team, it is goodbye and God bless.